Good morning from our global headquarters in New York. I'm Mitesh Parikh. You're welcome to Bloomberg Brief. Let's set that agenda. Bracing for CPI, risk markets seek guidance on the evidence to bolster an extended pause. Washington seeks to tighten its grip on the chip flows to China with fresh regulations aimed at producers around the world. And big bank earnings kick off. JP Morgan, Goldman Sachs, Wells Fargo and Citi all on deck. Let's just check in on those markets. It's going to be a bumper day for those bank earnings, as we say to you. But your risk is this, CPI. The consensus is around plus 0.3%, but the market is expecting a 1% swing in these equity markets, probably the biggest day since March 2023. If it comes in as a hot print, you shred the rate cuts and you embolden the hard pause narrative. David Costin over at Goldman Sachs likes the mid-caps relative to the large caps. As you can see, mid-caps pacing ahead up by 0.5%. It is ground zero to the burning in the bond market. Has it stopped is the question you need to ask yourself. We'll talk to Mitesh Parikh in just a moment on that. 4.76 is where we are. A note from RBC Blue Bay, Mark Dowding, a big bear on these bonds. He said, look, when the long end of that curve hit 5%, for him, it was a signal of a top. But we'll talk about the provocation from the five-year inflation expectations. There are some stocks that we are keeping an eye on for you, and this is the roll call. TSMC, well, we're keeping an eye on that. This after the US plans to introduce new regulations to prevent advanced chips from being sold to China, targeting chip producers. Also watching Apple, as TSMC is a major supplier to the iPhone maker. As you can see, they're up 0.2%. Now, KB Home's great numbers yesterday, rising after Seaport Global Securities raised the recommendation on KB to neutral from sell after the company topped out on their estimates. And in just a few moments, as I say, we'll catch up with Mitesh Parikh of Schonfeld, and later in the hour, Keith Lerner of Truist will join me. My first guest of the day is Mitesh Parikh from Schonfeld. His outlook for the year is this. As we enter 2025, markets are navigating a unique combination of macro forces, a sharp repricing in interest rates, tightening financial conditions, and shifting geopolitical narratives. I'm pleased to say he joins me now. Mitesh, in terms of the daily news flow that we're getting, the momentum is building there. We're devouring policy balloons that go up, but we are recalibrating. We're forced to recalibrate because of the bonfire in the rates market. To what extent are you recalibrating the level of risk that you will take right now?
Yeah, hi, man. It's nice to be back and good to see you again. Look, I think the first thing to say is that we have had a significant repricing of term premia across bond markets everywhere. It's been driven by the US, predominantly by the Fed, who kind of shifted to a more hawkish stance at the last FOMC meeting. And look, with that comes a lot of opportunity. As we've seen, the vol environment has increased quite significantly now that Trump has come in, and we expect that to continue. So I just think 2025 will be a very different market environment to 2024, where the sharp of being long equities was exceptionally good for the majority of the year. This year, I think it's going to be much more choppier. It's going to be more of a trader's market, and there's going to be a lot of opportunity to be able to lean into dislocations.
Let's just dig a little bit deeper into the bond repricing. You say a great deal of the move is attributable, 70% of it is to term premium. When I look at the 5-year forward break-evens, Mitesh, this is flagging still that this bond market has still further to dislocate. Would you agree with that, or do you think that we're topping out in terms of the run higher in yield?
Yeah, so look, I think what's interesting is that the shape of the curve, if you look at the OIS curve in the US, is actually exceptionally flat, especially between kind of the 2-year and kind of 7-8 year point. And really, we're in a data-dependent environment now, in the sense that labor markets have been exceptionally strong in the US. That continues to be the case. The 6-month run rate is still around about 165,000 jobs being created, but the unemployment rate's just a little bit higher than 4%, which is historically very tight. So, look, we've got a big inflation print coming up. The market's kind of leaning into a 0.3 on core. No one's expecting a 0.4. I think that is, a hot number on that print would obviously be something that would cause further ruptures in the bond market and, a much more aggressive sell-off. The front end only has about 23, 24 basis points of cuts priced left for this year. But again, no one's really expecting 0.4. That's obviously the risk, and I think that would pressure equities as well further from here. And conversely, a softer number would see a little bit of relief. But to answer your question, I still continue to think that the US consumer is very durable, and with Trump coming in, policies most likely to be on the inflationary side, bonds could still remain under pressure for now.
Well, this is the debate, isn't it, whether we're in a danger zone. Stephen Major sat in the very same seat that you were in 8 days ago. He said that he sees this bond route, the area we are, 4.7, maybe even to 5%, as an opportunity in a danger zone. How do you look at that, given what the Treasury Department told us last night, $2 trillion for the calendar year in terms of the fiscal deficit, $87 billion in December? There is a moment where this exorbitant privilege could be challenged, isn't there?
I don't know. I take the other side of that a little bit. I'd say if you look at the forecasts from the Congressional Budget Office, essentially we're running a debt to GDP ratio around about 100%. In 10 years' time, their forecast for 2034 is around 116%. For real debt sustainability questions to be raised, you're going to be running something like 250% of GDP in terms of a debt to GDP ratio. Japan is somewhere around that, but Japan has a lot of household savings, different demographics. The US is a very deep and liquid market. The dollar is obviously very prominent in financial markets, and the Fed have a lot of credibility. So, yes, while I agree that we can see more term premium being priced into the back end, I'm not entirely convinced that we're in the realm of seeing bond markets and back ends completely run away because of deficits at the current time. And then look, in terms of pricing right now, I guess it really depends on where's a buy. Like at the front end of the market, I think 2-year yields are now yielding higher than where Fed funds is. I think that's relatively asymmetric. At this point in the cycle, if there was to be any sort of shock, then while the market can still price further moves higher in yields, I don't think there's a ton of room at the front end for that to happen. I certainly think the bar for a hike is very, very high, but at the back end, things can keep going. And, you can see the curve still meaningfully steepening from here. 2-10 swaps are, only just positive. So there's still potentially a lot of room to go, as investors demand more return for, owning duration in the US.
I think it's very fair to take the other side of the trade. I think the market, the bond market, most markets are worried about the fiscal discipline and largesse that is set to come. I like the phrase that you use on the dollar, and I'm curious to what you make, how you expound on this. You see it as a wrecking ball, but it's a wrecking ball of destruction for emerging markets. But what's the tail risk of this stronger dollar to the US?
Yeah, so look, for multinationals and corporates, obviously it's probably, it is impactful to their balance sheet, as the dollar continues to strengthen. And if you look back over the last few months, we've seen a 9% increase in dollar strength. So, that does generally impact some of these multinational corporates that have meaningful exposure overseas as the dollar gets stronger. Look, I think with everything, some of these themes have become a little bit mature. We've seen meaningful moves, and certainly the market's pretty positioned long dollars as we go into this CPI print. And we have seen a very significant reprice in duration and the front end of curves. Now, that doesn't mean it can't go further, but I think you've got to think about differentiating between different markets. Europe, China are fundamentally in very different places to the US. UK also, from a stagflationary perspective, in a very different place to the US as well. So I think we're going to see much more differentiation across markets as we head into 2025.
Okay, dexterity is the name of the game, and differentiation. Mitesh, thank you very much for setting the agenda this morning. That is Mitesh Parikh of Schonfeld. Other stories trending on your Bloomberg terminal this morning. This is what we got. Residents of Southern California are facing another night of critical fire danger due to returning Santa Ana winds and minimal humidity. The region has seen little rain, with a death toll of at least 24 and a massive destruction. New estimates of the total losses in the insurance industry are now seen as high as $40 billion. The BOJ Governor Ueda joined his deputy in signaling the potential for an interest rate hike next week, which led to a boost of the yen. He also indicated rising confidence over wage increases after hearing encouraging views at the BOJ's recent branch managers meeting. Overnight index swaps show a 68% chance of a rate hike later this month. South Korean President Yoon has been arrested by investigators after repeatedly defying summons to appear for questioning over his martial law declaration. The arrest makes him the first incumbent president in the country's history to be taken into custody. Yoon will be held for 48 hours before potentially being detained for 20 days. Coming up, tighter grip on the chip makers. Washington plans another round of regulatory push on producers. More on that story next. It is Bloomberg Brief. I'm Mitesh Parikh in New York. Let's just check in. We've just finished a conversation with Mitesh Parikh there of Schonfeld. This is about volatility. This is about being dexterous in the year ahead. And ground zero for that is the foreign exchange market. This is what we've got for you at the moment. We have seen serious moves on the CPI in the UK, a slowing in UK inflation. And that brings sterling back to 122 is where we are. Traders are now fully pricing 2 cuts for 2024. The dollar on the back foot, it's going to be a wrecking ball, according to Mitesh Parikh, in terms of its influence on the emerging markets. Also keeping an eye on dollar yen for you. I mean, this is going to be a hot meeting in January 23rd and 24th. A hot meeting. Ueda joining his deputy on the risk of discussing a rate hike. So dollar yen is certainly worth keeping an eye on. Well, in the US, we've got new regulations to prevent, you got it, advanced chips from being sold to China and calling for more diligence from the chip makers. That's after an incident last year where TSMC found that a client was delivering its chips to Chinese tech giant Huawei. Let's discuss what this new edict is about with our global tech editor, Peter Ahlstrom. Peter, it seems as if it's sort of like the last pull of the noose around China in these closing days of the Biden administration. What are they now targeting? What's the advice to the chip makers? And is the onus of responsibility on self-policing sort of in a new way?
Yeah, it's almost hard to keep track of how many regulations the U.S. government is coming out with in the last days of the Biden administration. We've had some of these new rules almost every day now. The latest round of restrictions from the Biden administration targets TSMC, Taiwan Semiconductor Manufacturing Company, really the most important producer of semiconductors in the world, along with Samsung and Intel. These are the companies that make chips for a bunch of other companies. TSMC makes them for Apple, for example, for the iPhone, and also for NVIDIA for their GPUs. But they also make a lot of chips for Chinese customers. They have in the past, and before U.S. government restrictions, they made them for Huawei and some other companies too. What they are now trying to do is tighten that ability to make chips for Chinese customers because, as you referenced, they found out that one of the chips TSMC had made, or one kind of chip that they had made, ended up in Huawei's AI servers. That's exactly the kind of shipment that the U.S. government is trying to stop as they try to hold back China's progress in AI in particular. And so they're trying to add some additional rules here. And now the presumption is going to be that these foundries, especially TSMC, cannot ship to Chinese customers without the approval of the U.S. government. In the past, the assumption has been they can unless the U.S. government blocks it. So it's an additional kind of restriction at this point. They're trying to tighten things up. But again, this is just days before the Trump administration takes over from the Biden administration, so it's not clear exactly how this is going to be implemented.
You know, listening to Gina Raimondo on her way out, this is about AI dominance in the United States of America and keeping it that way. That's the critical policy. Let's talk about the last roll of the dice for Gary Gensler. He's going after Elon Musk, the SEC. They're preparing to sue him. This is about how he built his stake, the timing of reporting and the building of his stake in Twitter, and what the impact that would have on the average shareholder. What is this lawsuit really about?
Right. So Elon Musk has had a number of clashes with the SEC over the past few years, especially under the Biden administration. The latest clash here is when Elon Musk was beginning to buy shares in Twitter before he did the full takeover of the company in March of 2022. He was accumulating a stake, and under U.S. regulations, once you get to 5%, you're supposed to disclose that publicly so people know maybe you're going to buy the whole company, maybe you're going to buy a bigger stake, and they can make informed decisions about whether they want to go along with an Elon Musk or whether they want to bet against him. But in this case, Elon Musk got to 9% again in March of 2022. And didn't disclose within the 10-day time frame that you're supposed to. He took 11 days. Now, Musk's lawyers are saying this is a very trivial matter, that the SEC is essentially harassing him over these kinds of issues. The SEC wants a penalty of about $200 million. Musk's lawyers say that that's ridiculous. It should be something closer to $100,000. So again, it's getting very contentious at this point. This, of course, comes on top of other clashes, like when Musk said he had the funding secured to buy out Tesla. That didn't happen. That led to another clash and some changes at Tesla because of that. But this is, as you say, this is Gary Gensler and Elon Musk going at it one last time before they change seats.
It's the last roll of the dice, Peter. Thank you so much, Peter Elstrom, there on the latest tech news coming up. Hegseth in the hot seat. 4.5 hours. More on the President-elect Trump's cabinet picks as they head to Capitol Hill today. Context Matters on Bloomberg. Good morning. It's Bloomberg Brief. I'm Mitesh Parikh here in New York. Your front pages from around the world. This is what we've got for you. First up, Wall Street Journal leads with the Gaza ceasefire deal is waiting on the Hamas side to give the final sign-off. Both Israel and Hamas have said all significant issues have been ironed out and that the agreement was at a final stage. Hamas then missed a deadline to respond to the agreement by several hours and has now gone silent. Next up, the New York Times leads with the former First Lady, Michelle Obama, will skip President-elect Trump's inauguration. The statement did not provide an explanation for why, but she also did not attend the former President Jimmy Carter's funeral. That was last week. Former President Obama is confirmed to attend. And on Bloomberg, Republicans rallied behind Pete Hegseth after his Senate confirmation hearing. He was hit by questions by Democrats over his qualifications and his character flaws.
Mr. Hegseth, I do not believe that you are qualified to meet the overwhelming demands of this job. We must acknowledge the concerning public reports against you.
Will you put your money where your mouth is and agree that when you leave this job, you will not work for the defense industry for 10 years?
Senator, it's not even a question I've thought about because it's not
think about
one
it right now.
It's not one. My motivation for this job
I understand
has never
that. I
been
just
about
need
what
a
could
yes or no
conceivably
here.
come next.
Time is short. I just need a yes or no.
I would consult with the president.
Joining us now is Ros Matheson. Ros, I watched a lot of this confirmation. I mean, Elizabeth Warren, apparently he's had a nomination conversion. I've heard of Damascene conversions. Now we've got a nomination conversion. Look, it was hard and heavy on his excessive drinking. He denied sexual assault. He said those were smear campaigns, his financial mismanagement of the not-for-profits. But the Republicans are galvanizing behind him. This is one showing and done. Your take?
Well, that's right. So you saw the chair of the Armed Services Committee, Roger Wicker, calling him unconventional, but saying all the same, you know what? You look at prior administrations, you don't really see that there's necessarily been a natural fit candidate either. I mean, we are talking about a very big part of the US government, both domestically and overseas. It was interesting, and all the to and fro in the confirmation hearing yesterday, as you say, a lot of focus on allegations that have been widely discussed for quite some time about Hegseth and, you know, excessive drinking, those allegations, but less about, you know what, if you're going to run this thing, how are you going to spin it? What are your views on some of these key points of tension around the world? What are your views about, you know, the structural future of the military? When you think about where you need to take spending for a military that's going to be fit for purpose in 5, 10, 15 years, what are you going to be doing about that? And there was very little meat on the bones in that hearing about what he would do if he was in the chair. And I think that's what people really wanted to hear about. It's like, OK, you're likely to be confirmed. We can see that now. But what are you going to do once you're in the job? And I think this is where it comes down to. And a lot of those allegations, just to reaffirm, were pushed back by Hegseth. They were allegations. They were smear campaigns on his drinking and on other impropriety.
when it comes to the background checks, and this is where the hearing really pushed hard, is that only Jack Reed and Senator Wicker will have access to that FBI report. Again, it's a question of whether this individual has the capacity, and this is where the Democrats really push back. Do you have the skills, the financial management, and the ability and depth and breadth of knowledge to manage the U.S. Defense Department?
Well, that's right. Again, that is the key question, because the US is obviously trying to avoid being pulled directly into conflicts overseas, but an enormous amount of military support has gone on for Ukraine, sending an enormous amount of US military equipment, long range, short range, artillery, and then thinking about, how the Pentagon needs to work with the defense industry in the US, looking forward, these very big defense contractors that are quite lumbering in some ways. They want to operate on long-term contracts. How do you get them baked into the psyche of where modern warfare is going? How do you get them to change production focus potentially? All of that's really delicate, and it needs that very long-range thinking about where the military needs to be.
And that's in part what Hegseth pushed back on, and he did say this was about advancing the technological capability of the military. Ross, we'll see you again. Thank you very much for summing that up. Today, of course, you've got Kristi Neum, Marco Rubio and Chris Wright all up on Capitol Hill. We'll talk more markets ahead of the CPI with Truist in just a moment. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Mitesh Parikh. Let's set your agenda. Bracing for CPI, risk markets seek guidance on evidence to bolster an extended pause from the Fed. Washington seeks to tighten its grip on chip flows to China with fresh regulations aimed at producers around the world. And it is a big bank earnings day. We kick off with JP Morgan, Goldman Sachs, Wells Fargo, and Citi, all on deck. And that bumper day for banks will help define risk. We're a little bit bid this morning. You've got NASDAQ futures up just under 21,000. Prepare for one of the biggest swings in these markets since March 2023. We're looking for a 1% swing around the CPI. Could it be hot? Not. The conversation we just had with Schonfeld, they think it'll come in at plus 0.3%. But you've got to be dexterous in this market. There might be some value. Let's roll it over and have a look at the bond market. The short end is where there's perhaps a little bit of mispricing. That's according to Mitesh Parikh. You maybe want to see a little bit more of the rate cutting cycle return in the back end of the year. 10s trade at 476. These bond markets are looking at the inflation expectations, which are rising and have been above the level that we saw at 2.5%. Bond yields dipped by 2 basis points at the moment. My guest this morning is Keith Lerner of Truist, the Co-CIO over there. Keith, looking at the bond market, 10s and 30s, the longer end of the curve is where you've had the dislocation, the highest level since 2023. The issue is this. You say that we need stability in the rates market to embolden the equity call. Do you think we're anywhere nearer the end of the tail wagging in the bond market? Let's start with what you need to set the risk table.
Yeah, well, great to be with you. I think you really framed that well. Well, if we go back to December 6th, when the S&P 500 peaked, what happened that day was that's when yields troughed. And since that period, we've been in an internal correction for this market as those yields have moved forward. So we do think, around this level, you're starting to see a little bit of stabilization. Obviously, that CPI report is going to be really important. But we do think we're getting closer to some type of stabilization. One thing that we're looking at that leads us to that conclusion is the U.S. advantage in yields relative to our G7 peers is the highest since 2019. And then we're also still seeing pretty strong demand from Europe and Japan. Again, it's all about the CPI report today, but we do think we're getting closer. And then yesterday in the market, you started to see things like mid caps, small caps, and utilities work. So the market's at least starting to lean that way.
And this emboldens the overall narrative about the flow of money into dollar, the flow of money into dollar assets. And that adds to the equity market story. We had Goldman Sachs on yesterday, and they said, look, you want to look at the broader market. I've got everybody talking about the broader market in terms of earnings and opportunity and discount to large caps. At what juncture do you want to be longer of the broad market, the Russell, relative to, let's say, the actual S&P, or for that matter, to Mag 7?
So the way we're playing this is we were positive tech all last year. We still think tech is the dominant theme of this bull market. However, late last year, what we did is we upgraded mid caps. And the reason for that is we do think there's going to be this seesaw, a tug of war between the macro environment where you'll see money shifting back and forth. It's going to be hard to time. Mid caps are cheap. They have better earning trends than small caps. They're also primed for that pickup in M&A that we expect, and they should also do good with deregulation and a resilient economy. So I think it's not just all or none. I think it's a combination of the two. As kind of just, again, dealing with this tug of war that's likely to continue this year.
Well, you also say that there's a tug of war between tech and banks. We're laying up for a big day in banks. Goldman's, JP Morgan, Wells Fargo, and Citi. So we're going to know a lot more about whether it was good volatility or bad volatility in the last quarter. But I think the assumption is good volatility, splendid investment banking, and we'll find out more about NIMs. How do you look at tech and bank? Banks have had a great run. And cast forward, we're looking for deregulation and a healthy story. Where do they fit in the narrative for you?
Yeah, it's similar to that kind of that large cap and mid cap. And when you think about tech, that's the largest component of the growth indices, and financials typically are the biggest sector in the value indices. I mean, so we're at this point we're overweight tech and we're overweight financials, so we're overweight both because of that seesaw. And I think in general on the financials that we talked about a little bit earlier is that we're still positive on the banks. One, we have a resilient economy, deregulation. We also have a positive sloping yield curve as well. Credit remains pretty firm as well. So you put all that together, I think this is still a good environment, and the technical trends are still favorable for financials as well. So we like them. Obviously, it's hard to say what's going to happen today, ahead of the earnings report. But as we look for this year, we're still positive on the group as a whole.
It's interesting when you open your app, sometimes my own personal app, you see the mark-to-market, and even a small move has an outsized impact on the overall portfolio. You said pullbacks are always uncomfortable, and these aren't even pullbacks, Keith. These are just moments in time of where we're retracing. Pullbacks are always uncomfortable, but they are the admission price to the market. So what provokes a scalable pullback?
Well, I think it goes back to the 10-year, right? So going to the first statement, we've had 30 pullbacks of at least 5% since March of 2009, right after that, where the bull market lifted off after the financial crisis. Despite that, this is a crazy stat, we're up more than 1,000% for the S&P, including dividends. So that's why we say this is the emission price of these pullbacks. But to your point, what causes something more sinister, again, not a base case, is that the overshooting yields goes much higher than even 5%. And it's the pace at which it goes and things become unhinged. That's not our base case. That's the risk. The good thing right now is even though as yields have moved forward or up, credit spreads have remained very benign. So we're not seeing something systemic at this point, but that's the risk.
Yep. If those rates do blow out hard and heavy above the 5%, it could be the dislocator that everybody's perhaps thinking is hiding in the tails. Keith, thank you very much. Keith Lerner there of Truist on the markets. Coming up, Elon Musk is in the SEC's crosshairs. The agency is suing the billionaire over his Twitter buyout. More on the story in just a moment. It is Bloomberg Brief. I'm Mitesh Parikh here in New York. Washington plans to roll out additional regulations to prevent chip sales to China, this time aiming at firms including TSMC, Samsung and Intel. Let's get to Tom McKenzie tracking the chip and tech stories. Tom, again, this is the last pull on the noose around access to chips for China. But what exactly is this regulation going after? Because we got the traffic light system on Monday about high-end chips. So what is this about? Self-policing? You keep an eye on where your supply chain is going to, where your chips are going to in the supply chain?
I mean, it's partly that, Manus, certainly, and it is, to your point, building on that traffic light system, the tiers 1 to 3 that were outlined on Monday by the Biden administration, with allies in tier 1, those who were considered, of course, enemies to some extent, China, Russia, certainly adversaries. on tier 3 and then in the middle the rest of the world. It's building on those regulations, and it's broadening and widening the net to some extent because it's targeting the foundries, so TSMC and Samsung and Intel, so the companies that have these giant foundries that actually churn out and produce the chips, who have customers in China. And the net is widened by making this any chip below a certain level, so 14 to 16 nanometers. Anything below that is now considered within this additional set or thicket of restrictions. It's about putting additional sand in the gears, essentially, and to try and close some of the loopholes that Chinese companies have been using up until now to get around previous restrictions in terms of getting access, particularly to the AI accelerators and the GPUs. There are workarounds, though, for companies that are on certain lists, certain approved lists. And to your point, this is as well about compelling TSMC particularly, but also Samsung, to ensure that they do have the due diligence, they do have the checks, and that they understand what previous regulations are in place, who are on the blacklist, who are on the approved list, and to ensure that their chips are not inadvertently getting to Chinese customers that are not approved by the US, because that has happened in the past, particularly around Huawei secretly getting hold of chips that were manufactured in the foundries of TSMC in Taiwan.
Do you think the regime, Tom, for compliance has materially changed? We're going to have a new administration, and the question is whether the enforcers that they have are going to bear real teeth, or are there subtle workarounds here?
Since October of 2022, there has been a flurry of restrictions, as you know, Manus, this thicket, this web of restrictions, increasing the pressure every time, making it more difficult every time to get particularly the most sophisticated chips, but also the hardware and the software as well into the Chinese market. Now, there have been the workarounds, there have been the third-party buying, there have been the opportunities for those players in the Chinese market to get hold of some of this kit, but it has become ever more complicated. Those who critique this measure say, of course, what it does is just accelerate the domestic spend on R&D investment in the Chinese market to try and catch up to US players. We know the gap is there between the US and China. We know that on some metrics it's starting to close, not the highest end, not the most sophisticated chips, not by a huge amount, but certainly when it comes to legacy chips, the next concern, and there have been some measures coming through from the Biden administration on that, has been a flood of legacy chips out of the Chinese market into the global markets. That is something that they're concerned about as well, and are working on proposals. What we haven't heard from the incoming Trump administration is anything particularly clearly articulated in terms of whether or not they unwind some of these restrictions or build on them, because their focus, of course, is on seemingly more broad-based tariffs with all the uncertainty that's involved in exactly what they end up looking like.
Tom, let's just square off with Elon Musk. He's in the sightlines of Gary Gensler. Again, this is the closing days of the Gensler regime at the SEC. What is this lawsuit about? It's essentially about retail investors like you and I. If we were long Twitter, were we given the opportunity to benefit knowing the holdings that Elon Musk was building up?
Yeah, the allegation is from the SEC, the Securities and Exchange Commission, that essentially Musk dwindled those retail investors out of about $150 million US because he built up that position without declaring it, now being transparent about that position build up. And of course, when it finally came to pass that it built up a 9% stake, the stock soared about 27%. So within that period of the build out of the stake above 5%, prior to him releasing that information, of course, people were also mum and pop investors, institutional investors selling Twitter stakes, and they made a loss, or at least they made less than they would have made if they had had that transparency around the information. That is the allegation from the SEC. Of course, Musk's lawyers have described this as a sham. They say it is part of a long-running, what they describe as a harassment of Elon Musk. It sounds very much like they're going to be challenging this. The SEC tried to get $200 million out of Musk to address this and finalise this and end this scrutiny back in December. He's pushed back on that. His lawyers saying any fine should be much, much lower than that.
Yeah, pretty robust pushback from the lawyer. Tom, thank you very much. Tracking the tech stories there, Tom McKenzie. Let's stay with Washington. It's a busy old week in Capitol Hill. The cabinet confirmation hearings in full swing. Incoming President Trump's pick for Defense Secretary Pete Hegseth appealed to Republicans who can confirm him without bipartisan consensus. But Democrats held him up to scrutiny with their time.
Mr. Hegseth, I do not believe that you are qualified to meet the overwhelming demands of this job. We must acknowledge the concerning public reports against you.
Will you put your money where your mouth is and agree that when you leave this job, you will not work for the defense industry for 10 years?
Senator, it's not even a question I've thought about because
You can
it's
think
not
about
one
it right
that,
now.
It's not one. My motivation for this job
I understand
has never
that. I
been
just
about
need
what
a
could
yes or no
conceivably
here.
come next.
Time is short. I just need a yes or no.
I would consult with the president.
Let's get to Washington. Bloomberg's Megyn Crane joins me. Megyn, I mean, Elizabeth Warren there. I've had Damascene conversions, people tell me, but I've never heard of a nomination conversion. Of course, this is quite a serious issue around women in combat in the military. Look, Megyn, I watched a lot of this yesterday. The allegations were hard and heavy on his excessive drinking allegations, and he denied these on sexual assault, on financial mismanagement in his not-for-profits. So it very much was a partisan blow-by-blow go at Hegseth. How do you think the Republicans will rally around him? Because the chair of the committee came out with a glowing report at the end.
Good morning. Yeah, so it was very much a partisan exercise. The Democrats took the opportunity to highlight all the negative news about Hegseth, and the Republicans really rallied to his side. I think the most important one was Joni Ernst, who is a combat veteran herself, and was really sort of the question mark as to whether he would get enough Republican support. And she, asked him some questions about women in combat, and really gave him the opportunity to take back the words that he said recently about women in combat, and that really sort of sets him up, I think, for a pretty easy nomination at this point.
And this is where he did push back and qualify time and time and time again, which was about the standards that were applied in the military for women in combat units, and a watering down of those standards in his view. The other narrative was this, is about your experience. It's 3 million people. It's a huge budget, a huge organization. And he lacks that sort of material knowledge of how to run it. But, what would it mean for the defense industry if he does take on this role? Because he talked a lot about technology, imbuing the Pentagon with technology and shifting the dial, really, in defense.
He did, yeah. He definitely highlighted his interest in growing the military, in shipbuilding, and technology specifically, and sort of refreshing the technology and bringing innovation to the military. There weren't a lot of specifics in how that would work, but it would be good news, for the defense industry, for someone who wants to sort of bring that investment to that part of the government.
So today we've got a roll call on Capitol Hill. Kristi Noem, Secretary for Homeland Security; Marco Rubio, Secretary of State; Chris Wright, he's of Liberty Energy, for the Secretary of Energy. So these are all the prospects in front of us now. Rubio is going to be really interesting, because this is probably our first understanding of, again, some kind of a qualification of what America first is, in his own words.
Yeah, it will be interesting to hear how Marco Rubio puts that forward. He's a longtime China hawk. He definitely will not have such a contentious hearing. He is a longtime senator, has really worked in the foreign affairs space for quite some time. So, it'll be more of an opportunity, I think, for the Republicans and Democrats to sort of make statements and put out their own interests in the public, domain, take an opportunity while they're on TV. I'm really interested about Pam Bondi's hearing, who's, up for Attorney General after Matt Gaetz had to withdraw. She is traditionally qualified. She's the Attorney General of the state of Florida. But, she's a longtime Trump ally, and there'll be a lot of questions about her ability to stand up to him, or her ability to act independently and maintain an independent Department of Justice.
Well, that was certainly one of the big themes yesterday during the Hegseth hearing, in terms of accepting orders and executing orders from a president that as defense secretary you may not necessarily agree with. So it was about truth to power. Megyn, thank you very much. Right. Megyn Crane in Washington. Day 2 of those hearings. We'll have it all covered. Let's pivot to Wall Street. 4 banks are slated to report their earnings this morning. Sonali Basak is the Queen of Wall Street. I don't know who the king of the Dawn of Wall Street is. Probably Jamie Dimon. The Queen of Wall Street on the banks is yourself. Good morning. Good to see you.
Good morning.
So this is going to be a question of whether we had good volatility, bad volatility, or just splendid Trump volatility in the final quarter. Lay out the roadmap. It's supposed to be quite a beefy and substantial earning quarter for the banks.
Very substantial. And knowing already that trading revenues are supposed to be up across the street for the top 5 banks, they're supposed to post the best quarter in 5 years. net interest income is also supposed to be coming in quite rosy. The problem is it going to this year? For JP Morgan, they tend to lay out an outlook for the year. For the past year, they had said they expect to have the full year net interest income revenue of roughly $92 billion. Can they surpass that in 2025? Now, interest rates have not dropped as much as expected. The yield curve is steeper. And so does loan demand meet the ability to bring in more net interest income at these levels? Also watching, of course, charge-off rates, because at this part in the cycle, we know lower-income consumers have been weakening, but has that drifted into middle and higher-income consumers as well? Is there some deterioration?
I mean, that typically is one of the canaries. And JP Morgan and the commentary that they make around the consumer and what Jamie Dimon has got to say or on that call is particularly important. On the investment banking side, if you look at Goldman's, I mean, the expectation is what? A 30% increase in global investment banking. You've got pretty healthy debt and equity capital markets. But it's more about what the roadmap for this year really looks like. We're going into a new political regime with deregulation. Everybody's hoping for this boom in IPOs and debt and equity capital markets.
The incredible thing, we spoke to UBS's Erica Najarian just yesterday, and she doesn't believe that the bank rises could be priced in at this point based on what you could see in terms of regulatory relief by lighter Basel III standards. Now, what does this mean? Interesting anecdote, for example, we spoke to Bruce Richards over at Marathon. End of last year, he said because banks have more capital on hand, they had hoarded all this capital in anticipation of those rules. They're now lending that out. They're not only lending that out, they're lending it out to private credit firms that are then going across the economy and lending that out even more. So leverage is alive on Wall Street here. The interesting thing, too, is you've seen capital markets take off already. You've seen leverage loans come back at scale. The question is, you still have a CPI print today. A lot of these issuances have been front run ahead of critical economic data because of volatility in the bond market. You asked a little earlier, was volatility stifling? The answer so far has been no. And we haven't seen August level volatility in the stock market either. So volatility has been the friend to Wall Street. Look at this year. Commodities are coming back, too, in terms of volatility. So that reaps good news for these big investment banks.
Well, certainly Mike Mayo over at Wells Fargo. I mean, he's hoping for a paradigm shift in terms of the earnings. We'll count you down. We'll both be together. I'll break them. You'll take the team through them. It'll all be on surveillance. Sonali Basak setting the tone for the earnings from the banks on Bloomberg. We'll set you up for your trading day. It is CPI day as well as Bumper Banks Day. It's Bloomberg Brief. I'm Mitesh Parikh in New York. This is what the rest of your day looks like. As we said, big bank earnings, JP Morgan, Wells Fargo, Goldman Sachs, and Citi all before the bell. Main event of the day is US CPI. That hits the tape at 8:30 a.m. Eastern. The consensus there is around plus 0.3%. And the confirmation hearings continue for Secretary of State, Attorney General, and a number of others, all on deck on Capitol Hill. The bond market will be the ground zero for reaction to the CPI. As I say, we've done our survey. Around 39 in that survey expect a rise of plus 0.3% on the core. 32 expect plus 0.2%. So what we really have here is this bond market just ticking down ever so slightly. You did make the highest level since 2023 on the 10-year paper and on the 30-year paper as the five-year inflation expectations pushed through the 2.5% level last year. But just a conversation with Schonfeld on this show. They see value at the very, very short end of the curve. I'll join the surveillance team. We'll break those bank earnings for you along with Sonali Basak on surveillance. The team up ahead.